Now, if I'm in a situation where I start to think, oh, I've lost all this money, so the system doesn't work, or maybe I'll say I don't work. I'm not a good trader. I'm not a good investor. Well, none of those ideas are going to be helpful for making money in the future. Basically, my mind is blown at that point. I'm in a situation where I can't make money at that point. And I've seen that happen over and over again. Situations like the bear market that we have this year, situations like the crash of '87, the mini crash of 1999, the Asian contagion of '98, the bear market of 2000 to 2002. These are all instances where people get frozen. Don't forget 9/11. That came on the heels of this 2000 to 2002 bear market. And that froze people in their tracks and stopped them from making back the money they lost over the subsequent 2 years. So really critical. Now, this year we've got the stock market down about 45%. With good risk management, we should be down about 5%. Well, we can make back 5% in just a couple of good days. Let's say a week, 2 weeks, a month. But how long is it going to take to get back that 45%? Now, back when I was running institutional trading desks, we stole an idea which I think came from Paul Tudor Jones. And the idea was that if a trader lost 1% in a day, they had to take the rest of the day off. If they lost 6%, then they had to take the rest of the month off. If they lost 6%, say in the first 2 weeks, then they had to take the next 2 weeks off. Now people have said to me, well, big deal, what, they get a free vacation? Yeah, but that isn't the way traders think. Traders have to trade. It's in their blood. It's in their bones. That's what they do for a living. It's their identity. But perhaps more important to that, it's also their paycheck. Yes, we're paying them a paycheck to come in and trade every day, and if we give them 2 weeks off, they still get paid that salary. But no trader trades for their salary. They trade for the bonus. Just as a story of my trading in 1990, yeah, I got the salary, but I wanted the 50%, I wanted the 20% juice on what I made for the other people, because that would have made me $1 million. Here's the situation where the trader, by being forced to leave, we called it putting him in the penalty box, by forcing him to go home, means that he didn't have the opportunity to get as big a bonus at the end of the year. So it was truly a big bonus. Now, I don't recommend that you use this 1% and 6% rule, but I do want you to realize that that's an important consideration. That's an important idea for you to think about, because it's the type of idea that can help create a more structured analysis of the risk in your account and a way to control the risk in your account so you don't get any big losing trades. Very important. I can't express that enough. When somebody comes to me and tells me that they're in a losing situation, almost the first thing I say is, show me your 10 worst trades. And if you were to go back over the last year or 2 years or whatever, and if you were to look at your 10 worst trades, and just imagine if you had used good risk management, you probably wouldn't have had those 10 trades. And how much more money would you have in your account if you didn't have those 10 losing trades? The other thing to consider is that the things that we teach at the Investment Mentoring Institute or on some of our online membership sites, the risk management tools that we teach, put people in the top 5 percentile of risk management in the country. That sounds dramatic. How could it be that just an hour's worth of teaching can put somebody in the top 5 percentile of all investors? Let me explain it. If you look at mutual fund managers are really not allowed to use stops. They have to remain pretty much 100% invested. So if they get stopped out of one stock, they have to substitute for another stock. So they really haven't cut their risk much at all. So mutual fund managers can't really use proper risk management. Pension funds, union funds, segregated funds. You combine those all up and you're probably talking about 60% of the money under management fall into those institutional categories where they're not allowed to cut the risk. Let's take a look at individual investors. I mean, I would challenge you to grab the next 100 investors you know and ask people, well, what are you doing for risk management? And the answer is going to be, for most people, they're going to look at you like you're some kind of a crazy person. Now, maybe some of them put stop losses on, and that would be good. That would be a good start for controlling the risk. But so many people enter the positions without thinking about the risk. For example, a lot of people will buy 1,000 shares of Google and 1,000 shares of Duke Power. Well, guess what? Those are two completely different risk profiles. More sophisticated investors will say, well, I'll buy $10,000 of Google and $10,000 worth of Duke Power. They're still not the same amount of risk, but in those investors' minds, it is the same amount of risk. So once again, they're out of control. The only people that are really good at managing risk are some of the hedge funds, and those guys are really, really good at it. And I respect them a lot for that, and that's why they continually make money, usually, year in and year out. The ones that use proper risk management live every year. The ones that cratered this year are the ones that didn't have proper risk management in their accounts. Those are the ones that you got to always be afraid of, because those are the guys that think they're geniuses. You know, the old saying is, don't confuse a bull market with brains. Those are the guys that are doing that. Instead, we should always assume the worst and hope for the best. But by assuming the worst, it's going to concentrate our mind on controlling the risk and not allowing ourselves to have the worst case scenario happen. I know I've been ranting about here, and I'm calling this video the Risk Rant. But I'm calling it the Risk Rant because controlling risk is the second most important thing in investment success. Strategy is number one. Risk management is number two. We need to have both of those. If we have a good psychology, we got a really big leg up on the game. But we still need to have risk management. Capital preservation is more important than capital appreciation. We've got to always remember that. Warren Buffett's 2 rules for investment success are: number 1, don't lose money, and number 2, don't forget rule number 1. Now, I have to challenge Warren a little bit, because in 2008, he's down more than the market is. He's down 50%. Of course, his portfolio is so large he can't really manage the risk in it very well. So, that's, once again, one of the significant problems of being a multi-billionaire is you can't control the risk. But you and I, we can control the risk, because we're just retail investors, and we can put in stop losses and do all kinds of things to control the risk. And there's no excuse for us to ever have big losing trades in our portfolios. Little ones, I'm going to have 1 million of them. From now until the end of my life, I'm going to have 1 million little losers. But I never want that big killer loser at all in my portfolio. So don't forget, I know I'm ranting, but this subject is so important. You've got to control risk, control risk, control risk, cut your losses, cut your losses, cut your losses. And then, oh, by the way, the profits will come. You'll let your profits run, and you'll make a ton of money in the markets. I'm signing out from this late night rant, but it just got me going.